you have got on your mind. Okay? One of the things that I'd like to say to class is that whatever you can come up with, whatever you can think of, we have thought about this long before you were born. Right? Why is that? Because we were once master students. Right? We have sat there before. So we know how students think, what students are thinking. Right? How good students think, how bad students think. All right? So, when, last year I used to give participation mark, where students, if they feel that they actively participate in class, right, or actively attend class, and I see every year, year in, year out, a very huge extent of dishonesty. Only a couple of students would ask questions, meaningful questions. The rest of the class simply can't be bothered. Just can't be bothered, didn't really pay attention. When the materials get a bit hard or complicated to understand, feel sick of it, why it's so tough, so hard, and yet they take, right? Give themselves participation ticks, participation mark. That's why this year there's none of that. Anyway, okay. So I think I suppose I've let you know the message. The class register at the front. I take a look. There are a lot of things that I want to say, that I can say but I don't want to say. That I can even take care of there and then, I didn't want to do. Okay? So when I don't do anything, or I'm quiet, I let things go, doesn't mean that I don't know. All right. But I had to go out again because last week I was so busy and I didn't take a look at the register. Where were we? Did you remember what I was saying at the end of class? What are we studying? At the bottom line? At the end of the day, what are we studying? What has been our approach? What has been our approach? What has been our approach? We start from somewhere simple, right? And try to analyze, try to rationalize whatever that is in front of us. Okay. If you get my point, you find it quite easy to understand dividend policy. Because the approach is exactly the same as when studying financial policy or leverage. the way, I have asked, talked to the authority in terms of clearance. Said that if there are students who would not do well at all. So the authority said, so be it. So be it. Okay. Now for debt maturity. We started off by looking at the implications of the 1958 irrelevant theorem. Okay. So if the theorem holds, let's say, all the assumptions hold, then debt maturity should be irrelevant to the value of the left-hand side of the balance sheet. Okay. But as we discussed last week, that's not quite the case. Okay. And we looked at the, people can call this contracting cost hypothesis. Okay. Or overall, right, this hypothesis, okay, implies maturity matching. And we also mentioned the existence, real world existence of the ALM desk at a bank, right? What do they match? What do these people match? What do they do each day? They get paid quite a lot of money, right? And they don't have to talk to a lot of people. These people are sort of well protected in the bank. If they're really good, they're well protected. They get paid quite nicely, right? And yet they don't have to deal with a lot, political problems in organization. Okay. If banks don't pay them well and they're that good, they can simply leave. You can work anywhere in the world, right? So what do these people do? What do they match? What do they manage? Asset liability management. They're matching, trying to match maturity. Okay. So matching what? Left-hand side to right-hand side. Maturity on the left-hand side, asset maturity. Right. And liability or debt maturity on the right-hand side. Okay. We discussed maturity matching in some detail. So moral hazard in the debt contract suggests that or implies, or you can predict maturity matching. For long-term, if a borrower or a firm wants to invest in a long-term project, in equilibrium, long maturity debt should dominate, in this case, dominate the financing choice. Okay, CPO is part of it. Okay, so that's the case. Long-term asset, long-term debt. Right. Short-term asset, short-term debt. Okay. A lot of growth. A lot of growth means a lot of new investment opportunities, a lot of growth options, potentially with the money hopefully. Okay. So in this case, maturity should be short. In equilibrium, long maturity should dominate. Okay, but in reality, what do we observe? What do we observe in reality? Do lenders decide, right, lenders on the lending side, do lenders decide on maturity based on moral hazard in the debt contract purely? Only? No, right? Because moral hazard is after the signing of the contract. What about before the signing of the contract? That's the information, right, that lenders may observe. Whatever information lenders may observe before the signing of the contract, does that matter to lenders' choice of maturity of the money that they will lend to the borrower? Well, none of us, I am quite sure that none of us would decline existence of moral hazard in the debt contract or the moral hazard program. Okay. Moral hazard is important. But why then do we still observe firms trying to finance long-term projects with short-term debt? We see mismatching of maturity between assets and debt. We do that. We observe that. Okay. At least we see very long-term project and not so long-term debt. A lot of short-term debt, right, in the financing mix. A bit of long-term. So overall, we see some mismatching. We can't deny that. We're not willing to deny or decline, right, or deny the existence of moral hazard. But at the same time, neither will we be willing to deny that there's mismatching going on. And the extent or the volume, right, the frequency of such mismatching that we observe in the real world suggests that these are not out of equilibrium decisions. They're not outliers. They're not out of equilibrium corporate events. For example, I would say that about 70% to 3/4, okay, of IPOs in the world, around the world, are underpriced. But of course, there are, let's say in this case, 25% of IPOs that are overpriced. So maybe 25%, these are just out of equilibrium transactions. A lot of people will say this. Okay. Anyway, we see a lot of mismatching. So why? What could explain such mismatching? So there's got to be something that is important enough to drive, say, firms, right, with a long-term project to borrow short-term, for example. Or drive, yeah, this example is clear enough. Okay. Now, let's go back to what we already know about this. Okay, moral hazard is after the signing of the contract. We've discussed this. What about before the signing of the contract, debt contract? Okay. There also exists information asymmetry as well. And in this case, asymmetry is called adverse selection. Okay. We know the nature of adverse selection. So because of adverse selection, insiders of issuers, right? If you run a firm and we want to borrow, in other words, we will perceive that our debt issuance, right, or debt offering, right, or our borrowing will be mispriced. Our debt securities, when we want to sell debt securities, our securities will be mispriced in a way that varies with maturity. Okay. Of course, the mispricing has to occur along the line of maturity in this case, because we're talking about maturity, right? Now, what if, let's think of ourselves as insider, the issuer. If we go for short maturity, immediately the implication is that in the near future, we need to reissue. We need refinancing in the near future. Okay. Now we work in the world of adverse selection in this case, right? Looking at adverse selection problem. So when we reissue or get refinancing in the near future, we will get refinanced at what rate? We will be thinking about that, right? Okay. Given information asymmetry and frictions and of course uncertainty, at some price, of course, we have to pay a rate, let's say, that reflects our true quality or our quality at that date, right? Yeah. Let's say in 2 years or 3 years time. Okay. In 3 years time, well, not so sure, but we have some expectation of our quality in 3 years time. Okay. And to the extent that we are insiders, we know ourselves, right? We have information about ourselves. What we're going to, how we're going to be in 3 years time, we can sort of tell. Okay. If, let's say, we suspect that life will be tough in 3 years time, we at time zero. Let's say nice and simple, in a year's time, we think our prospects not looking so good. We don't expect an upturn, a good state, fantastic state of nature for our operation. Okay, we don't expect that. What sort of maturity would we go for? If we go for short maturity, we have to refinance in a year's time. Exactly that. Let's assume that's the case. Would we try to lock in? So the lock in, right? Make sure that, okay, anyway, if there's uncertainty, downside uncertainty about our prospects, if we expect that, so if we could get long maturity, right, yeah, we can at least postpone, right, the negative impact of such downside uncertainty on our ability to refinance. Of course, if we will still get refinanced, but there's a risk of paying high interest charges. In this case, we may as well just lock in, right? Okay, inside, okay, only this much of the spray, okay, and lock it in the long run, okay. All right. Would we do that if we are borrowers? Yeah. If we're not so sure, okay, let's go for long term then. At least we definitely have the money. Don't need to refinance. Because if we have to get refinanced again, well, we need to talk to banks again, lay all cards on the table again, right? And banks can decide again whether or not to charge us more, okay? So the implication of this decision structure is that lenders in the market, okay, outsiders of the market, we talk, what market we are talking about? Fish market or debt market? It has to be debt market straight away. When we say market, yeah, we can think, yeah, lenders in the market, the outsiders. Given this decision structure, right, and the fact that we don't know, we are lenders now, we don't know the true time. Okay? So we, being the market, being outsiders, we infer from the choice of borrowers, of firms, right? Firm's choice of maturity. Long maturity, let's say, if the borrower say, yeah, we would like long maturity, please. So it's likely in this case that insiders of that firm, right, or firm, expect downside uncertainty about their refinancing prospects. Okay. But if they don't, so if they put quality absolute top notch, maybe they should wait. In case the quality improves at the time of refinancing, right? I'm not getting up there to write time zero, time one. When they say this, you need to translate this into a picture. Timeline. Time zero, thinking, right? Current issue. Are we going to go long term or short term? For example, okay? At time, if we go short term, at time one we have to get refinanced, have to issue. if long term at time 2, we don't need to worry about time. Okay. So in this case, you are lenders. I'm the borrower. I am the firm. I'm insiders. If I expect my quality to improve, I'm really good quality. Would it go for long term? No, no. Okay. If my quality improves at time 1, then I would. If I expect that, I would go for short maturity, right? Because I want to renegotiate. Hey, look, see, better collateral for you. Come down in the rate. Okay. If you don't come down in the rate, then I go to a different bank. All right. So, given adverse selection in this case, you will definitely, right, by definition, you perceive higher probability of default than I do, than insiders do in general, because of the adverse selection. Because only the bad type would go for long maturity, would ask for long maturity. Okay. Is this setup any different from 8 baht, 10 baht from Myers and Maslow adverse selection? There's no need to try to memorize. The only thing you need to memorize is that how to spell maturity, what maturity means. Means how many years, right? Yeah, so other things constant. The level of debt, amount of borrowing constant. Long term, short term. That's what maturity means. Okay? The decision structure is exactly the same. If it's not exactly the same, I can't teach. I wouldn't be able to teach because it's too complicated for me to understand. The fact that I can understand, it means that it is not that complicated. If we do it, if we take the right approach, adopt the right approach. Okay, not the left approach, right approach. Okay. So in this case then, I'm insider. Well, there's adverse selection. Okay, I'm a 10 baht firm. In this case, I'll get underpriced. Right? In other words, my debt will be priced too cheap. Okay, holding constant covenants. Never mind constant. Suppose there are no covenants. Okay, I pay interest charges. They are too high. Okay, so technically speaking, I say that all market determined, okay, or default risk premium in the market will be excessive, too high, given my quality. Okay, that is, my debt is too cheap. I have to pay premium. I have to pay premium. Right? Pay premium means high interest charges. Okay, to bring that money into the firm, into my firm. Okay. And of course, we talk about maturity. So the premium should be worst, right? Should be most excessive for long maturity. Okay. Or the underpricing of my debt is largest when maturity for long maturity relative to short maturity. Who would go for long maturity? The bad type. Right? Relative, of course, good and bad in this case. Okay. So we have a prediction. Good type would go for short-term debt. Bad type would go for long-term debt. And this is how suppose I'm the good type, I separate myself from the pool. Right? In this case then, in this structure there will be a separating signaling equilibrium or separating equilibrium where I use my choice of debt maturity to signal my true type. And I use my choice of debt maturity to signal my true type when I borrow. Right? Not when I pay dividend, because we're talking about debt maturity. Okay. Now, in this argument along the way, of course, there's one implicit assumption that we will get refinance most definitely. Either good type or bad type, right? There'll be refinancing for sure. Okay, that is, all of the projects facing firms have positive NPV. Okay? The problem is just whether I will get refinanced at a high rate or low rate. That's all. Okay, the risk of paying more or paying less. Well, paying less is not the risk. Okay. What if we relax this assumption? Positive NPV project. What if at time 1, we are at time 0, what if at time 1, the project we hold, okay, on the left-hand side of our balance sheet, turns out to have a negative NPV? Or the probability that the projects that we have at time 1, we have negative NPV. Okay. In this case, then, if we go for short maturity, and right, the projects that we have to lay on the table in front of lenders actually have negative NPV. We won't get refinanced at all. Right? In this case, we have liquidation in front of us, facing us. Okay? So, if we take into account the possibility of illiquidity, no refinancing, no money at all, not just refinancing at a higher rate, but no money forthcoming from banks or from lenders at all, okay? We allow for this possibility, then nice and clear. If bad news arrives at time 1, we are dead meat, right? No money. We'll be short of money. Yeah? People call this liquidity problem. Right? Firms do it well. So-called practitioners want to use the term fundamentals, right? I just told, a couple of weeks ago, I just told a group of high-level people that I don't understand what you mean by fundamental value. Although this term exists in the textbook. I'm not an academic, I don't understand. I just know true value and price. If you want to go fundamental value and all this, yeah, I don't understand. Can't be bothered anyway. Intrinsic value, another term. I don't know how to calculate intrinsic value. I just know just true value, right? And price is a proxy for value. Yeah? Price is a proxy for value. How do you know that the value, true value of a stock has changed? Price has changed, right? If there's new information, right, and let's suppose that information is relevant to the stock. Information is that this price is positive. The value should go up, shouldn't it? But if there's no trading, would value still go up? Yes. Investors can still update. Investors can update the valuation of the stock, but they don't have to trade the stock. But once they trade the stock, price will move. If there's no trade, would price move? No. Right. And this is the problem. One well-known problem in finance, which is called thin trading. Right? This is thin trading. And when you do equity valuation, this is a serious problem. Okay? When you have to estimate a stock systematic risk, thin trading is a huge problem. If there are true price innovations, investors have updated their valuation of the stock, but they don't have time to trade the stock. Let's suppose these are small stocks. Okay, the stocks that we're looking at are small stocks. So even when there's new information coming to the market and prices is supposed to change, but it's because there's no trading, So price hasn't moved yet. So it appears the return is 0. And therefore value hasn't changed. But actually, value has changed. How do we know that? Well, there will be a big jump later on. Or when there will be a change in value of these stocks. The price of these stocks will change even when there is no new information coming to the market. So how could price change? Because investors trade. But why do investors trade these stocks now? Well, they have time. Earlier, they were busy rebalancing their portfolio, right? Focusing on large stocks. The stocks that receive large rates in their portfolio. Okay, so this is a big problem. All right. So in this case, bad news arrives. Back to our debt maturity here. Bad news arrives. People react. Lenders react. Okay. No lending, no refinancing, please. Okay, they react in this case. So, what could be the implication here? What would be the choice of maturity across different types of borrowers in this case? I can't remember the lecture notes that I've written. You have speak, or you speak about like what? Tempo kids. You know tempo kids? Typically tempo boys, right? When there's left over from month, right? Then it's for the boys in the tempo to eat. I have participated in the meal, in the feast once, right? The big boys go like this. You want to eat? Well, that's life. Okay, good. There's no table. No photo taking. No photo taking. Because I think the next slide will be a table. Okay? You need to... Why are you looking at me like that? You looking at me like that? Like you want to bite me. But there's no barking. Like Bang Kao. Straight away. Similar to Ajahn Ratachai. You studied with Ajahn Ratachai. First half, right? Bang Kao, right? He's like Bang Kao. Okay. He doesn't bark, he bites straight away. Next week is midterm exam for the undergrads. Right, for your junior friends. I think about 30 students will withdraw. Last year there were about 120 students, 130 students, okay? And this semester, 120 students. And then after the midterm exam, about 70 students remain. Withdraw. Okay. Allowing for illiquidity to enter our decision. Okay. Now imagine ourselves as borrowers. Allowing liquidity to enter, allow the possibility of no money forthcoming from bank when bad news arrives. Bad news is negative NPV. Okay, we at time 0, we're thinking about time 1. We don't know exactly, so let's think about probability of negative NPV project. Let's call this probability of bad news. And this is private information. Okay? There are two pieces of information. Something that banks can see, lenders can see. Let's call this rating. The label they already have. A piece of information in the public domain about ourselves. Okay? If we are good type, very good type, most definitely very good rating. Okay? And we also have low probability of bad news. Okay, negative NPV project at time 1. Bad news, probability of bad news is our private information, right? The source of adverse selection here. Lenders cannot observe this, cannot verify this exactly. Okay? Lenders can tell this, good rating. Have this label. Okay, let's say we have good rating, investment grade. And our private investment grade, lenders can observe, right? And we also are good type. We have good quality. Our private information suggests that at time 1, no problem or whatsoever. Not even getting refinanced at a bad rate. Okay, let's call this good quality. What sort of maturity would we choose? We go for short maturity, right? We want to pay less, right? We want to pay less, we get charged less. How? What's the mechanism? Right? This is a mechanism. Okay. The default risk premium will be highest or most excessive from insider's perspective for long maturity, because it's the relatively bad type that would go for long maturity. Okay. So we still have this structure in our analysis, even when we allow for the possibility of illiquidity, of no money, right? No money forthcoming from lenders at all. Okay. Now let's suppose now we're not so good rating, not that bad, but lower, another notch down, suppose. But our private information suggests that we're not going to have problem. We won't have problem, right? We get money for sure. Let's call this lower quality. If we are lower, but not low, lower quality, okay, in this, with this structure, the label, our label, that is publicly observable, is at not so good rating. So there's a risk in this case of having to pay higher rate at time 1. But we will get our money for sure, because we don't expect to get bad news. We don't expect bad news to arise in our case. No bad news. This is our private information. Okay? But we may end up paying higher rates because our rating is not so good. There's a refinancing risk. This risk of paying relatively high rate, but we'll get money for sure. Okay? In this case, naturally, we go for long maturity, right? To lock in. Okay, paying a bit more, but this is the way to minimize our refinancing costs. Okay, yeah, pay a bit more now, because at time 1, right? If you go for long term now, we pay. Let's say our spread is 1.5, right? But if we go for short term, and at time 1, when we refinance, the spread could become 1.75 or 2%, for example. Okay. Now, if we have good rating, investment grade, but our private information suggests that, look, at time 1, we may not get refinanced. What would we do? If we go for good rating, we go for long maturity, we would be revealing our true type, right? That our private information suggests that we expect trouble at time 1. In this case, banks may say no, right? Bank may say no, okay? And our rate will be very high. We may get in trouble even now. Good rating, but this is how people see us. So good. But actually, we could
we expect to get broke, to be broke at time 1. A negative NPV project. So when this uncertainty is resolved in time 1, if that's the case, okay, we won't get money from bank for sure. Okay, my structure. But we are at time 0 now. What are we going to do? So if we good rate it and we go for long term, hey, good time, don't go for long term. You label as good time. How come you're going for long term? When there exists probability of bad news in this definition, okay, negative, that is negative NPV project. If you went for long term, you get labeled as a troubled type. Let's call this poor quality. Okay, poor quality. This is the poor quality, the rock bottom. Okay, firms that we have really bad news, right? Collateral no good at all. Okay. All right. So if I were in this group, I would go for short term. Right? Intuitively speaking, hopefully, right? In layman's term, let's buy time. Let's buy time. Go for short, try to mimic. Well, the ratings here, my good ratings, at least for one period, allows me to mimic the good quality time. Okay? I don't want to get labeled as a bad time, poor quality time. Okay. So we can call this here sort of lower quality. I could go that way or that way. My label now is up there. So let's maintain, try to buy time for now. Okay. Then at time 1, let's wait and see. Okay. But if I go for long term now, it's nice and clear mismatching, right, between the known equilibrium choice and label. Okay. Then this basically creates even worse adverse selection. Okay. Of course, as you can see here, the poor quality will come down to this. Poor quality, okay, will be forced to borrow in short term, but when it's forced, the rate is high as well. Okay, but right now, if I voluntarily go for short term, at least lenders can't tell, right? Because bad news is my private information. Okay, probability of illiquidity. Okay. Now, not so good rating. I have this high probability of bad news. What should I do? Not so good rating. Okay, I just go for long because I'm not so good anyway, right? Okay, go for long, same as this type. So try to avoid being labeled as poor quality. I don't mismatch, I behave, I go along with the pack. Okay, hopefully I won't get caught up. I won't get caught. Okay, not so good rating. Now, let's say I'm done, right, below investment grade, speculative, speculative, low rating, but somehow my private information suggests my label is bad, okay? The market labels me as really bad, speculative, but actually my private information suggests that I don't have that. The probability of illiquidity is very low. This type does not exist in the debt market. Because I'll be better off staying off the debt market. If you go to the debt market, it gets worse off. Okay. Let's call this mistaken labeling here is fine. Right, it's fine. Even good rating, but my private information is that I have bad news, and bad news, not so good ratings, not so bad. So I still benefit from being in the debt market. Okay. But if the mistake on the labeling is in this direction, I get in the debt market, there's nothing for me, right? I'll be worse off. So in this case, I don't go to the debt market in the first place. All right? Then how would I get financing for my good projects? For my positive NPV projects, I use equity, and maybe there's no debt. Okay, so this type does not exist in the debt market. Now, the last type, low rating. High probability, low ratings, bad label, very speculative as label, and probability of bad news, prospect of bad news. Probability of illiquidity is also high. Speculative, right? This is the label. People see me as bad, and I know that I'm a bad type. At time one, I expect illiquidity, that is, the project turn out to have negative NPV. So let's call this poor quality. Then we can do this. Okay, poor quality. Maybe lender wouldn't want to know me in the first place, right? At time zero, no lending in the first place. But let's suppose somehow I manage to offer high return. Does this exist in the real world? Speculative zero. Have you heard of speculative zero? What's that? Junk bond. Junk bonds are speculative zero. Right? Zero coupon bond. Junk bonds don't pay coupon. In the US market. It's US market. Okay, US literature. Okay. So in reality we have this as well. Okay? Very poor quality. But if I could offer high interest charges to lenders, if that exists, the price is right, there will be transaction. So, say the interest I offer is high enough. In this case, lender will say yes, okay. But you can't go on long term at all due to risk. Right? That is, I would prefer long term. I'm a bad type, right? I want to get locked in. Make sure that I get money, I get liquidity. Okay? But lender will say no. It's good enough that you get money at time one. At time zero. Good enough that you get money at time zero. But money is not going to be with you for too long. Okay? You need to come back at time one, but not at time two. Back at time one to talk. I prefer long term, long maturity, nice and clear, right? Very, very bad time. But lenders say no from the label. So there's no mistake in the labeling. Okay. I would ask for long term. But then they say, no, low ratings. You have low ratings, and yet you're still in the debt market, you're not worse off, right? If you're low ratings, right? If it's not worth getting labeled as